Welcome to this explainer. Okay, let's dive into this. If you're managing, or even just thinking about managing a self-managed superannuation fund, you probably already know it's one of the most powerful wealth creation vehicles out there. But with great power comes some incredibly intense scrutiny. For the 2025 to 2026 financial year, the rules are stricter than ever. Today, we're walking through a really high-stakes guide to SMSF compliance. We're taking you straight from the technical rulebook to the harsh reality of how it's actually enforced.
To make this super clear, we're going to navigate the life cycle of a fund logically. First, the sole purpose. Then, contributions and pensions. Third, investments and related parties. Fourth, audits and compliance. And finally, winding up. Section 1. The sole purpose. Trustee duties and the golden rule.
Right, before we really jump in, I've got to give you a fair warning. As we go through each of these areas, you're going to see that every single stage has some pretty catastrophic tax traps. We have to start with the foundational legal requirement of an SMSF and the absolute unshakable responsibility that falls entirely on you, the trustee. So let's lay out the basic rulebook. Structurally, a fund maxes out at 4 members, and all of them have to be individual trustees or directors of a corporate trustee. But here is the most critical point. Trustees are personally liable for breaches. If something goes sideways, the fund doesn't take the legal hit. You do. You've got to prepare annual accounts and lodge the SMSF annual return on time. The golden rule, the whole reason the fund is allowed to exist in the first place, is that it has to be maintained solely to provide retirement benefits to members or death benefits to dependents. Oh, and to keep it completely objective, you absolutely cannot be paid for your trustee duties, even if you're a qualified professional. Pivoting over to the harsh reality of the ATO's strictness. Under Section 62 of the SIS Act, it's generally illegal for anyone to get a benefit from the fund outside of that core retirement purpose. Even a tiny incidental benefit before you retire can completely breach the rules. You've really got to aggressively document the commercial rationale for every single related party transaction. Slip up here? Well, penalties range from fines and mandatory education all the way up to being fully disqualified as a trustee.
Section 2. Contributions and pensions. The strict limits of money in and money out.
Let's transition into the actual flow of money into and out of your SMSF. This is where we divide things into 2 distinct phases. First, the accumulation phase, where earnings get taxed at 15%, and then the holy grail, the retirement or pension phase, where earnings enjoy a gorgeous 0% tax rate. Now, looking at the shifting caps for the 2025-26 financial year, your concessional cap is $30,000, and that's stepping up to $32,500 in 26-27. Your non-concessional cap is sitting at $120,000, moving to $130,000 next year. And if you're under 75 and meet the total super balance rules, you can use the 3-year bring forward rule for up to $360,000 right now. But listen, here is a massive trap you need to memorize. Funds have to be received and completely cleared into the fund's bank account by June 30th. Just hitting transfer on your banking app on June 30th, not going to cut it. If the money clears on July 1st, it counts for the next financial year, which can so easily cause you to accidentally breach your caps.
$2 million. That is your transfer balance cap for the 25-26 year. This one number dictates exactly how much capital you are legally allowed to move into that beautiful 0% tax pension phase. It is literally a hard ceiling on your tax-free wealth generation. So the crucial point is what happens once you're actually in that pension phase. You are legally required to make minimum annual pension payments out of the fund. If you miss that minimum payment, even by a single solitary dollar, you forfeit the tax exemption for the entire year. Let me repeat that because it's huge. $1 short on your withdrawals and your 0% tax environment just vanishes. Your fund goes right back to being fully taxable for the whole year.
Section 3. Investments and related parties. Navigating the 5% boundary.
Now we're shifting focus to how the fund actually deploys its capital to grow wealth. Pay really close attention here, because this is where the most dangerous compliance minefields are hiding. The investment rulebook demands absolute commercial purity. First off, you have to have a written investment strategy that explicitly covers risk, return, liquidity, and insurance. And every single investment must align with that document. When dealing with related parties, your permitted acquisitions are super restricted. You can basically only acquire listed securities and business real property from them, and it has to be strictly at market value. Everything you do has to be entirely commercial.
5%. I really want to draw your attention to this vital number. This is the absolute cap on in-house assets. Under the rules, any investments in, loans to, or leases with related parties combined cannot exceed 5% of your total fund assets.
Let's see how this builds into one of the most devastating mistakes trustees can make: the family rental breach. If your SMSF buys a residential property and you decide to rent it out to a family member, even if they are paying full market rent, you instantly shatter both the in-house asset rule and the sole purpose test. Residential property rented to family is strictly forbidden. It turns out the ATO is definitely not interested in subsidizing your nephew's gap year housing. And the consequence of that breach? It's absolutely staggering. If you violate these rules, the ATO can issue a non-compliance declaration. And when they do that, they don't just tax the offending asset. The penalty is that your entire fund gets taxed at up to 47% on its total assets. Literally, decades of wealth building can be totally wiped out by one bad rental agreement. Which brings us to a concept every single trustee needs to understand: NOLI and NAIL. This stands for non-arm's length income or expenditure. The law requires every transaction to be at market rates, and it is incredibly critical to realize that this arm's length requirement applies to your expenses just as much as your income. Getting a special mate's rate on services for your fund isn't some clever money-saving hack. It triggers massive tax penalties. And this brilliantly illustrates how easily professionals can get caught out. Take a look at the accountant-trustee trap. According to LCR 2021/2, if you're a professional accountant and you're also the trustee of your SMSF, and you prepare the fund's accounts using your firm's software without charging the fund the full market rate, you trigger NOLI. You're acting in a non-trustee capacity, using business equipment, and undercharging for it. The result? The fund's income gets slapped with a 45% tax. Trying to save a few $100 on software can literally cost you nearly half your fund's income.
Section 4. Audits and Compliance. The ATO's watchdogs.
All right, we're moving now to the enforcement side of the SMSF lifecycle. Because of all the wild traps we've just talked about, the whole system relies on a mandatory annual independent audit to keep everyone honest. The mechanics here are completely non-negotiable. You have to get an annual audit done specifically by an ASIC-registered SMSF auditor. They aren't just checking your math, they're assessing your financial position and your strict compliance with the rules. This audit has to be completely finalized before your annual return can even be lodged. And remember, auditors are not your secret keepers. If they find reportable breaches, they are legally required to lodge an auditor contravention report directly with the ATO.
Which leads us to a pretty glaring trap: attempting to use a related party auditor. You cannot just appoint your own accountant to audit the fund's books. Using a related party is a direct contravention of the rules. The auditor has to be truly, undeniably independent. The ATO relies heavily on this exact independence to police the whole sector.
Section 5. Winding up, closing the doors correctly.
Finally, we reach the end of an SMSF's life cycle. A wind-up is usually triggered by some major life event. A member's death, a divorce, members moving their money to an APRA-regulated fund, or maybe the SMSF just isn't economically viable anymore. But you can't just empty out the bank account and walk away into the sunset. Extinguishing the legal entity requires a very rigid sequence of steps. Step 1. You absolutely must legally roll over or pay out all member benefits. Step 2. You have to get a final audit completed and lodge a final SMSF annual return that explicitly marks the fund as wound up. And Step 3. You have exactly 28 days from the fund ceasing to exist to formally notify the ATO.
If you miss those final steps, you fall straight into the ghost fund trap. Like I said, simply taking the money out is not enough. If you fail to lodge that final return or fail to notify the ATO, the fund is still technically active in their system. That means late lodgement penalties and compliance obligations are going to continue to accrue, just haunting the trustees long after the fund has practically shut down.
Which brings us to our final thought. Are you prepared to manage a tax vehicle where a $1 mistake costs you everything? The reality of SMSF compliance in 2025 and 2026 is one of absolute zero tolerance. It demands meticulous record-keeping, strict commercial independence, and a really deep, abiding respect for the rulebook. I hope this explainer has illuminated the true stakes involved here and helped you evaluate your own readiness to take on or continue this massive responsibility. Thanks so much for joining me. Stay focused and keep learning.